So, welcome everyone to yet another revision session for my lovely South India students in 100% English. And in this session, we are going to revise our lovey-dovey Index 10, that is events after the reporting period. So, before starting the revision, if you are watching this on YouTube and if you are not subscribed or if you have not shared this with your friends, very bad, huh? Very bad. And also, if you like it, do hit the like button. The board notes which I use in this index, I will upload on my Telegram. You can join through the description. Link is in the description box. Okay. And in this revision, I will revise the concepts and I will also take up some good, tricky, important questions revision in this. Okay. So let's start the revision in 3, 2, 1 and go. First of all, index number is index 10. Name events after the reporting period. Acha, if I want to give you a gist of it, what is this events after the reporting period? So you can see, let's say for example, this is my financial year end. Okay. So the events which occur between the year end and the date when these financials are approved by BOD. So the events which occur here are events after the reporting period. Okay, and these can be two types of events, adjusting or non-adjusting. So if you look at the definition, it says these are favorable and unfavorable events that occur between end of reporting period and the date when FS are approved. Acha. Here one more point is given. What if, let's see my example. What if I am a listed company? Okay, so this financial year ends on 31st March and this financials are approved on 14th August. But between these date, one quarterly statement was submitted to by the listed company. Does it impact my events after reporting period? The answer is no. It does not impact. There is no relevance of this issuance. Okay, do remember that part. Anyways, then there are two types of events. One is adjusting event and one is non-adjusting event. What is the meaning of adjusting event? It basically means that something which already existed on the balance sheet date and after year end you got some additional evidence. Sir, what is the example? Example you can take. For example, I made a sale to my debtors. Now someone did a case on my debtor before year end, and after year end my debtor lost the case before FS were approved. So this debtor losing the case is a additional evidence of the condition which existed on the balance sheet date. Okay, so it is a adjusting event. Do remember that part. So if it is a adjusting event, what will I do? I will adjust in my financial statements. So I will take this treatment on the year end only. So if my debtor has become bankrupt, I will increase the provision for debtors now. Okay, then what is the meaning of non-adjusting event? Any event whose condition was not existing on year end, it directly arose after the year end. So it is a non-adjusting event. What to do with this? Don't do anything. Name itself says non-adjusting. Don't do anything. If it is material, then disclose in the financial statements. Sir, give us an example. Example, some fire occurred after the year end. So this is the non-adjusting event as we had no clue on the year end for this. Done, sir. Understood. Then there are some special cases. In module there are 3 special cases. I have discussed 4 of them. Okay, you will come to know how. First, dividend declared after the reporting period. If any company declares any dividend after year end but before approval of FS, it is a non-adjusting event because no liability for the dividend existed on year end. Okay, what will you do with this dividend non-adjusting event? Just disclose in the notes to accounts. Okay, then going concern is the second special case. If any non-adjusting event occurs but it affects your going concern assumption. Let's say fire occurred, but because of this fire, now your going concern assumption is no more valid. You will treat this fire like a you will treat this fire like a adjusting event. Ideally, it was a non-adjusting event, but if it affects your going concern, treat it like an adjusting event. And if I am treating like an adjusting event, what will I do? I will prepare my financial statements on liquidation or realization basis. That is, I will change my basis of preparation. Acha. What if because of this fire, my going concern assumption is not affected, it is still valid? Then it was a non-adjusting event. Disclose only if material. Okay, sir. Then the third case, interesting case. What is that? Suppose you breach a long-term loan arrangement. Okay, so let's say you took a loan on the first day. Before year end, you do a breach, and from the date of breach till year end, there are no talks of grace period or no talks of removing the condition of breach. After year end, suddenly the condition of breach got removed or you got a grace period of more than 12 months. So how to treat this event? You will treat this like an adjusting event. That means because of this event, your loan will again become non-current. Because when the breach happened, it became current. Now, after year end but before approval of FS, if we remove the condition, treat it like an adjusting event. And because of this, on year end, the loan will again become non-current. I discussed the logic of this in the class. I'm not going to the logics because it is a revision video. Do remember that. Anyways, chalo. So, Acha, one question will also arise. So this is FR with exclusive. What is exclusive means? This is not there in anywhere. We have built this based on our understanding. So what is this? So the breach point was also there in Ind AS 1 now. So what is the difference between the point we discussed in Ind AS 1 and the point we're discussing in Ind AS 10? So it basically means that in Ind AS 1, when we did the breach before year end, and when we took the grace period before year end only. But in Ind AS 10, we did the breach before year end, but we took the extension or we removed the condition after year end but before approval of FS. That is the basic difference in the point of breach of Ind AS 1 and Ind AS 10. Anyways, acha, there is one more special case related to inventories. Okay, so this is nothing but a summary of all adjustments of inventories. If you know this summary, all types of questions get covered in this summary relating to inventories. There will be no more confusion. So what happens is, in question they say the NRV falls after the reporting period of inventory. Okay, if the NRV falls after reporting period and there was a condition existing on year end of this fall, then adjusting event. Acha, what if NRV falls after year end but there was no condition existing? So why did it fall? It fell because of the price change or market fluctuation. Then also, as a special case, you will treat this fall like an adjusting event. I know there was no condition existing on year end, still treat it like an adjusting event as an exceptional case. Acha, what if the NRV of inventory falls because of a fire or water leakage, and such fire water leakage happened after the reporting period? If any event happened after the reporting period, then such fall in NRV will be also a non-adjusting event. In this case, it is a non-adjusting event. So if value of NRV falls because of normal cases, adjusting event. If value of NRV falls after year end because of fire or water leakage after year end, then non-adjusting event. Do remember this. Examples are also given in my notes. Again, I'm saying this board notes I will upload on my Telegram. If you feel the examples are good for you for understanding, you can refer them. Anyways, acha, then also after this, I discussed a few special cases as well. Few special examples also I discussed, in case you remember. First, let's say for example in 11-12 fraud happened. Management found about this fraud after the year end. Adjusting or non-adjusting? Treat it like an adjusting event. Don't say management did not know about this fraud on year end. Array, that is management's inefficiency. Can I say the fraud existed on year end? So it is adjusting event. Similarly, for example, if you are doing a construction and after year end but before approval of FS, you came to know that construction cost will increase because of a rocky surface, okay, which the company identified after year end. But can I say if a rocky surface exists in the land, it was existing from day one? So if the cost of construction goes up after year end because of any structural fault which was existing from day one, I have also mentioned that due to a rocky surface which the company identified later on, of course it existed from the start of the contract. We came to know later on. So in this case also treated like an adjusting event. Do remember that. Okay. Acha, also one more thing. If any event occurs after the financial statements are approved, okay, in that case don't call it a non-adjusting event. If any event occurs after the FS are approved, it is out of the scope of Ind AS 10. Why? In Ind AS 10 only those events come which happen between year end and date of when FS are approved. All events are out of scope. Don't call it non-adjusting event. Okay. Okay, sir. Now this was the conceptual part of it. Also one more concept is there, that is Appendix A. It has nothing to do with adjusting, non-adjusting. It is a special guidance which is given for dividend. So when you give dividend in non-cash form, let's say for example you give dividend in the form of a PPE, you gave one of your owner a PPE for free. So in that case it will be treated like a dividend in non-cash form, and the fair value of that PPE will be the amount of dividend considered. Okay, got it, sir. Now let's take up some good questions which I feel are good for you. One question is illustration number 15. We already discussed this. You know rocky surface wala example which I gave you. Rocky surface you came to know later on, but of course it existed from before only. So treat it like a adjusting event. Okay, then there is illustration number 16 also. What is here? So basically there was a case which was ongoing in 11-12 and we won the case later on. So adjusting event because the case was existing from 11-12. Okay. Acha, in some questions the reference of 37 is also given. So if you have read Ind AS 37, you will understand the reference. Just do give it a read. Acha. Illustration number 17. What is there in this? I am just giving you an overview revision. Huh? So for example, we are entitled to a duty drawback in a certain year. For that, we have to file an application within 15 days. We filed the application late, but we received the duty drawback. Okay. So in that case, this event is a adjusting or non-adjusting event. This is a adjusting event. Why? Because the condition of this already existed when I was entitled for the drawback, right? But again, give the referencing of 37 as well. Acha. Then 21 again is a good question. What is happening here is in 11, 12 you did certain transactions for which excise duty was to be paid, but you paid less duty, and because you paid less duty here, you got a notice in the next year. Okay, so now this notice, because of the notice you have to pay a penalty of some amount, adjusting or non-adjusting. So it will be an adjusting event. Why? So the condition of notice did not exist on your end, it existed when you paid the less duty on this financial year. The condition already existed by default of receiving the notice, so it is again a adjusting event. Do remember that part. Okay, then we come to the MTP RTP questions. First question has two parts where we are giving some discount on sale. So discount can be of two types. It can be trade discount or it can be any other discount, cash discount or something. If you are giving trade discount now, you will record the sales at net of discount. But if you are giving any other discount, you will record the revenue separately, you will record the discount separately. In this case, it was given not in the normal course of business. It was not a trade discount. So we are treating it separately. Do remember. Acha, second, we entered into a sale deed on 15th March, but the registration was done on 20th April. Adjusting or non-adjusting? Can I say sale deed was entered on 15th March? Registration is an additional evidence of condition already existing, so adjusting event. Do remember that part. Acha. Question number 2. So what happens is the value of inventory is falling due to market fluctuation. So if the value of inventory falls after year end due to market fluctuation, adjusting event. So cost 10, NRV 7.5, write down of 2.5. In the next year, the NRV increased. So, but whenever the NRV increases in subsequent years of the same inventory, whatever write down you did, you can reverse it. So we will reverse the write down of 2.5 which we did in the previous year. That's it. Only this much is there in this question. Then question number 3, a very classic question. It has 4 questions. We have to tell them whether adjusting or not. So first case, there was an arbitration which was ongoing in the current year. We won it. The company says because it is favorable, because we won it, they have not taken the effect as adjusting. Arey baba, event after the reporting period includes both favorable as well as unfavorable events. And because the condition existed, it is an adjusting event. Second part is that inventories only. The value of inventories fell after year end, but because of price change, adjusting event. Third, debtor became insolvent and the proceedings were going on before year end only, adjusting event. Fourth, we announced a restructuring after year end. So this starts only after year end. Nothing was existing on year end, so non-adjusting event. Okay, I gave you some hint on presentation also. First define Ind AS 10 events after reporting period, then define adjusting, non-adjusting, then for all the 4 cases answer in one sentence. Simple. Chalo. The most classic question of all, that is question number 4. Before revising this, I would like to highlight this. Please write and practice at least 2 to 3 times. Okay, now what is there? We had a warehouse available for use from 2016. Okay, now there was a structural fault. What is the meaning of structural fault? Just like rocky surface, it existed from before only, we came to know afterwards. Acha, so when did we came to know? If in case you want to see, I prepared a timeline also for this. So we came to know in the December is the year end. Okay, we came to know in Jan-Feb 2020 about the structural fault, and because of this fault, they are saying it is an indication of impairment. So you have to conduct the impairment test, but because it is a fault which is an adjusting event, you will not conduct the impairment test in Jan-Feb 2020. Instead, because adjusting event, you will conduct the impairment test in immediately preceding financial year, that is 31st December 19. So to conduct impairment test, we need 2 amounts: carrying amount, recoverable amount. What is the carrying amount? We already have it. What is the recoverable amount? We already have it. Carrying amount, you have to find it. Day 1 cost to have life normally is 30 years. So keep on depreciating. 1, 2, 3. We depreciate till 2018. Now, for 2019, a revised life is given. So the revised life is given as 20 years. Okay, but ideally the revised life should have been applied from 31st December 19, but they have applied from 1st Jan 19. Okay, and this 20 years is given in terms of 2016. I want the revised life in terms of 2019. So if as per 2016 the life is 20 years, if I want the life from 2019, how much it will be? 20 minus 1, 2, 3. So you will get 17 years. Okay, so what they are doing is, you have the cost of 2016, depreciate as per the normal life for 3 years, 16, 17, 18. Then for 2019, because we are assuming that the life has reassessed On 1st Jan 19, you will take the reassessed life and find the revised depreciation. Okay, I also discussed this in detail. Of course, I'm just doing a revision of this. Okay, do remember that part. Okay, so you will get the revised depreciation as per the revised life. Again, I'm repeating, the revised life, if you read the question, it is given as 20 years, but 20 years is given from which date? From the date it was ready for use. Okay, so 20 years is given from 2016. We have to find the revised life from 2019. So if 20 years is from 2016, revised life, in terms of 2019, it will be 17 years. You can calculate, you will get the same answer. Okay, so you get the revised depreciation of 2019. Then we get the carrying amount on 31st December 19 recoverable. We have passed the entry for impairment loss. Also, we will pass an entry for depreciation. In this question, they assume that they have passed the depreciation of 2019 incorrectly at 33,333. But the right amount should have been 5941. So they pass the incremental depreciation. Okay. So this is the first part of the question. Out of this whole calculation, you might see it that it is really tricky. Only one part is important here. Calculation of depreciation for this year. If you can crack this, rest remaining full question is manageable. Okay. Acha, there is a second part of this question also, that the damage to inventory has happened because of rainwater leakage. Water leakage is causing the damage, and water leakage happened after year end. Remember my chart. If damage to inventory is because of fire or water leakage, non-adjusting event. Yes sir, we remember. So damage is happening because of a water leakage, so non-adjusting event, sir. So I've given this. See, water leakage happened after year end. Okay, which damaged my inventory, non-adjusting event. Disclosive material. Acha. Then third part is also asked in this question. What if the damage to warehouse, that is PP, was due to an event caused after 31st December 19? That is, will your answer be different if there was no structural fault? It is saying that what if the damage to warehouse was not because of a structural fault? If structural fault was not there, then it would have been a non-adjusting event, no? Because the whole point of treating as adjusting was because there was a structural fault, right? So if damage to warehouse was not due to structural fault, it would have been a non-adjusting event, sir. Then there is one more question, question number 5, which is a basic, very simple question. It is saying that inventory is damaging, fire has damaged my inventory, so non-adjusting event, but the accountant is treated like adjusting event. So just give them the correct treatment as well. So this completes our revision of Ind AS 10, a very quick revision, a very good revision. I hope this was helpful for you. Okay, so thank you so much. If you like, do hit the like button, and also do comment whether you liked this session or not, so that I can upload more such sessions. Okay, thank you so much. Bye bye everyone. Take care. See you all. Bye bye. So welcome everyone to this amazing session where we are going to revise our lovey-dovey, cute, little Ind AS 8. Right, in this revision session, we are going to revise all the concepts along with all the questions as well, right? All the important questions, you can say. So if you are watching this on YouTube, and if you are watching the revision lecture without subscribing or sharing with your friends, it won't be helpful. So first subscribe and then see the lecture. Yeah, chalo. So let's without wasting time, let's start the revision in 3, 2, 1 and go. Acha, before we start, the board notes which I used in this Ind AS, I will upload on my Telegram channel. Link is in the description. You can join it, and you can download that board notes as well. Chalo. Now let's start the revision in 3, 2, 1 and go. So first of all, number Ind AS 8, name, accounting policies, changes in accounting estimates and errors. So basically whole Ind AS is divided into 3 parts, if you can see. The first part is accounting policy, second part is accounting estimate, third part is error. Now let's start discussing about accounting policies. Now what is the meaning of accounting policy? In case you remember, I linked the accounting policy with relationship. Okay, you might be able to recall that example as well. Chalo. So first we define what is accounting policies. What is it? So whatever principles, basis, conventions, rules, practices you use. Where do we use? In preparing and presenting financial statements are known as accounting policies. Sir, give some example to understand this. Basically, if you are following cash, accrual or hybrid model of accounting, that is accounting policy. Choosing between cost or evaluation model is an accounting policy. Choosing between FIFO or weighted average or specific identification method is also an accounting policy, right? So first they have defined what is accounting policy. Next point. For each transaction, how do we select and apply the accounting policy? So first we will take guidance of Ind AS. If specific Ind AS is available for that policy, follow the Ind AS. If Ind AS is not available, then you will use a judgment. For example, what is the transaction where there is no Ind AS available? Do you remember we discussed about cryptocurrency? There is no Ind AS as of now on this, right? So for this particular transaction, management will use judgment, which policy to follow. While using judgment, do remember that you should use such method which should result in more relevant reliable information. And while making judgment, if there is any index, use that index. If index not available, use the framework. If that is also not available, use the pronouncements, okay, of IASB or other standard setting bodies. If none of these is available, then you can check what everyone is in the industry is following, that you can follow as well. Acha. Whatever you follow, whatever you choose, you should apply it consistently. Let's say for example you choose any model, so for our similar transaction you should use same model. But if any index permits category wise applying the model, then that is also allowed. For example, do you remember in index 16 it was said that for same class we will use same model, for same class we will use same model, right? That means if there are different nature of different class of assets, in different class different model is allowed. Similarly, index 8 also says that when you're applying policy, you can check whether the respective index permits category wise applying or not. Similarly, in inventory also it was there, same nature of inventory, same method. But if the inventory nature is different, you can use different methods for different nature of inventory. Anyways, then change in accounting policies. Can we ever change our accounting policy? The answer is yes, in two cases. Which are those two cases? First, if it is required by Ind AS, or second, if it results in more relevant reliable information, that is you are changing it voluntarily. Acha. Now if you see the flow of accounting policies, it is defining, then selecting, then whatever you select apply consistently, then fourth discussing whether we can change it. Just like relationship, first defining what is relationship, then selecting a good girlfriend boyfriend for yourself, then whatever you are choosing for yourself, you will at least think that we will keep a long-term relation, we will try to marry that respective person. But if something goes wrong, of course we can change it, right? Change can happen because of two things: either your parents don't approve the girlfriend boyfriend, or you are changing it voluntarily because you find a better prospect. Same is the case with policy. In our case, parents means Ind AS. If it is required by Ind AS, change the policy. Or if you feel that you have a better prospect, if you feel that any other method can result in more relevant library information, use that method. Remember now, we use this example? Yes, sir. Acha. In following two cases, these are not changes in accounting policies. There are two examples given. First, application of accounting policy for transactions that differ in substance from those previously occurring. In case you remember, I discussed, let's say for example, you were under Ind AS 16, you were following revaluation model. Now you shifted to Ind AS 40. In Ind AS 40, we have to follow cost model. Now once you reclassify your asset from one Ind AS to another Ind AS, and because of it the model is changing, it is not change in policy, it is first time adoption of policy. Similarly, let's say if you bought Ind AS 40 IP for the first time in your life, and if you apply any accounting policy to this is not changing policy, this is first time adoption of policy. Okay, then fifth point is applying changes in policy. How do you apply any change? So if you must see, you are changing the policy because of whom? If you are changing the policy because of Ind AS, and that Ind AS might have given you specific transitional provisions, follow the transitional provision given by Ind AS. Acha. If you are changing the policy because of Ind AS, but Ind AS does not include any specific transitional provisions, in that case you will apply the policy retrospectively. Acha. If you are changing voluntarily, that is change was not required by Ind AS, but if you feel that it will result in more relevant liable information, that is why you are changing it, so you will also apply the change retrospectively. Acha. Whenever we say we have to apply the change retrospectively, we have to prepare opening balance sheet, that is balance sheet on the day one of previous year. Two more important things: if you are adopting any Ind AS before it is applicable, early application of Ind AS, this won't be treated as a voluntary change, do remember. Second, if for example for any transaction you are following a pronouncement and any amendment comes in the pronouncement because of which your policy also changes. For cryptocurrency, let's say you were following cost because of the pronouncement. Now the pronouncement changes and it says you have to follow fair value. Now because of any pronouncement amendment, you are changing the policy. This will be treated as voluntary change and not the change required by Ind AS. Do remember. Achha. Now they talk about retrospective application. Whenever you apply anything retrospectively, you will also have to prepare a third balance sheet, as you already discussed, opening balance sheet on the day one of previous year. So what is the purpose of preparing a third balance sheet? In case remember, I also told you, see, whenever let's say for example you are changing the policy, from FIFO to weighted average. So you will apply the change from current year. Then you will apply the change in current year comparatives, right? So in the previous year column, when you are showing the comparatives, instead of FIFO, value the invented weighted average. And whatever effect is there before previous year, because retrospectively means you have to apply as if you are following this new policy from day one. So current year effect we gave in current year, previous year effect we gave in previous year. What about the effect of before previous years? That will give in opening balance sheet. Do remember that part. Okay, yes. Acha. Also one more thing is given. Sometimes retrospective application is impracticable. That means it is not possible to apply from first day. So whenever it is practicable, apply from that particular day. Disclosure. Whenever you change a policy, disclose the nature, reason, effect. If the retrospective application was impracticable, disclose the reason for it. And if any new index is issued but not yet effective, that means any new index is going to come in future, the draft is ready but it has not yet become effective, in that case you should disclose this fact and the possible impact of that new index. Just like if you are getting married, if you are going to get married in future anytime soon, tell the impact to your friends that I'm gone now and what is the possible impact on our life. Similarly, if a new index is going to come, not yet effective but draft is ready, so disclose the fact along with the possible impact. This was your accounting policy. Next, accounting estimate. Do you remember I also made you write some extra theory part in the accounting estimate? So what are accounting estimates? Basically, whenever there is any uncertainty relating to measurement of any asset, liability, income, expense, that is accounting estimate, right? Now, company develops estimate to achieve the objective set by policy. That means estimate is the step 2 of policy. Sir, give us example. Let's say you have a PP. So in PP, you can apply cost model, you can apply revaluation model. So applying any of the model is a policy. But if you are following reval model, you will have to find the fair value. Finding the fair value is the accounting estimate. So it says company develops estimate to achieve objectives set out by the accounting policy. And also you will have to use judgment and assumptions while developing accounting estimates. Examples are given. Loss allowance of expected credit loss, basically impairment loss as per 109 is an estimate. NRV of inventory, estimate. Fair value of any asset liability is an estimate. Depreciation of PP is an estimate. Provision for warranty is also estimate. Clear with this? Yes, sir. Then, if can you change any accounting estimate? Yes, you can change in 3 cases. Either you receive any new information because of which you feel that you will have to change your estimate, or you get more experience. You feel that the past estimate is not proper, you have to increase or decrease the estimate based on your new experience, or there is any new development due to which you feel the estimate can change. Due to these 3 reasons, you can change your estimate. Acha, whenever you change any estimate, so estimate is always applied prospectively. Prospectively means you will not change your comparatives. The day you decide to change the estimate, from that particular year apply the change. Do not touch the previous year figures, right? So you will apply the change from the date of change in estimate. It may affect only the current and future periods but not the past comparatives. Okay, 3 clarification points are given here. First, can change in estimate be related to prior periods? The answer is no. Change in estimate is applied for prospectively, so never change the comparatives. You cannot change the prior period items. Change in the basis of measurement, whether it is a policy or estimate. Example, choosing between cost and revaluation model is a policy or estimate. We already discussed, it is a policy. Also, for any particular transaction, it is getting difficult to distinguish between a change in policy or a change in estimate. Always treat it like a change in estimate. Simple. Next point is disclosure. Whenever you change a estimate, disclose the nature, amount, effect. Okay. Now next part, errors. Do remember when you will call anything as an error? If you committed any error in previous or before previous year, but you came to know in the current year, that is an error, right? If you did an error in the current year, but you found it in the current year, that is not an error. So error is omission or misstatement. Omission means you forgot it, or misstatement means you recorded it incorrectly. In entities financial statements for one or more prior periods. So it should relate to one or more prior periods. Why did it arise? It arises from failure to use or misuse the reliable information. So you forgot to use it, or you misuse the reliable information. Which information? Which was available at that time and could reasonably be expected to have been obtained. So if that information, if you have made reasonable effort, you could have obtained that information. So if you could have obtained that information, but you did not and you forgot to use it, that is a omission or error, you can say, right? Acha, if this information was unable, you could have put in reasonable effort, still you would have not got this information, and in case because of that information you did not record anything, that is not an error. So basically error will only be called as an error when you forgot to use the information which was available. If that information could not have been made available, then it is not an error. Okay. Then types of errors are there. 5 types of errors are there. First is mathematical mistake. Self-explanatory. Amount, you have got it wrong. Second is mistakes in applying policy. That means example is given. Asset liability should not be offset unless permitted by Ind AS, but still you offset any asset liability. Misinterpretation of facts. You treated any adjusting like a non-adjusting event or vice versa. Omission. Forgot to record any particular transaction. Fraud happened which you came to know later on. Okay. Now, accountant treatment of errors. Please listen to me carefully now. If error relates to previous year. Okay. If error relates to previous year, how will you rectify the error? You will apply it retrospectively. It means you will change the comparatives of previous year. Now, because you are only changing the comparative previous year, opening balance sheet is not required because no amount will change the opening balance sheet. But if the error relates to before previous year, in that case, you will apply retrospectively, and in comparatives, prepare one extra balance sheet, that is opening balance sheet. Okay, and you will change the amount in opening balance sheet. Okay, then note is given, whenever you give retrospective effect, prepare opening balance sheet. If retrospective restatement is impracticable, give the reasons for the same. And also one more thing, whenever you restate, whenever you apply anything retrospectively for previous year, use the words restated. Okay, do remember. Disclosure is required, nature, amount, and if the retrospective restatement is impracticable, give the reasons for the same. Now, important point here. There is something known as classification error. What is the meaning of classification error? It means you incorrectly classified any particular item. So if for example, if the classification error is of a P&L item and it relates to previous year, example, you classified a finance expense under other expenses. So the classification went wrong, but there is no mistake in the amount, only classification mistake is there. And if that classification error is of a P&L item, you will rectify the error in previous year compared to P&L. No need to prepare the opening balance sheet. Okay, but here comes the exceptional case. Okay, if classification error relates to any balance sheet item, you showed any current asset item like a non-current item, okay, in previous year. So we will rectify the comparatives of previous year, but you might say that because it relates to previous year, we need not give opening balance sheet. You are wrong. It is the only case where even if the error relates to previous year, you will have to give the opening balance sheet, which is that case classification error of a balance sheet item of previous year. So in this case, you will have to give the opening balance sheet. Okay, do remember this part. So this was the conceptual discussion of Ind AS 8. Of course, there are many questions which are very straightforward. So my focus will be more on those questions which are crucial from your exam point of view. Okay. Illustration number 9, you should read it. See what it says. I will give you an overview of it. So there is a company who was selling and fitting the carpet. Okay, selling and fitting the carpet, giving the service of selling as well as fitting it. And they were booking the revenue after fitting the carpet. Now, the company changed the business model. They shifted only to selling. Fitting, they would provide a third party support. So now they are booking the revenue directly after selling. Directly after selling, not fitting. Now they are booking the revenue directly after selling. So is this a change in policy? The answer is no. Not a change in policy. Sir, why? Sir, you are changing the policy of revenue booking now? This is not changing policy. Why? Because you are changing the method due to a change in business model. Your business model previously was sale plus fit. Now it is only selling. That is why you have changed the revenue booking. So this is more like a first time adoption of policy and not a change in policy. Do remember that part. Okay. Then we can proceed further. Direct questions are there. Please give it a read. Okay. I'm focusing more on those questions which are critical. Illustration number 17 is there. So basically in this question, we are changing the policy from FIFO to weighted average. And because you are changing, the retrospective impact have been given. As if you were following the new method from previous 3 years, there would have been such increase in the closing stock. Okay. And as per the old method, 2 years profit and loss is given. RE balance, return earnings balance, as on opening day of previous year is given. You are required to present the change in policy in profit and loss and produce an extract of SOCE, statement of changes in equity. Balance sheet is not asked. Do remember that. We know that whenever apply accounting policy retrospectively, we need to give opening balance sheet, but balance sheet is not asked. Okay. There is no concept of opening profit and loss. In profit and loss, you give only 2 columns, current year, previous year. Okay. Do remember that part. So how do we solve this? So in case you remember, I made you prepare some draft trading accounts, right? So whatever is the effect, you will come to know. Like in 2 years before, your closing stock would have increased by 10 million given in the question. Due to this, my GP would have increased by 10 million. So if this closing stock would have increased, the next year's opening stock would also have increased. This impact is given. Net GP impact increase in 5 million. If this closing stock would have increased, next year's opening would have also increased. Closing is given, net GP impact 5 million. Simple. Right. So these are the 3 trading accounts I prepared. Now, due to the change in method, which of the amounts in this full P&L will change? Only COGS amount will change. Right. So if you see, revenue will remain the same. What about COGS? Do remember the formula for COGS. It is opening plus purchase minus closing. What is the meaning of this? If your closing stock is increasing, closing stock is less from COGS. Increasing closing stock will reduce your COGS. Apply some common sense, right? So don't look at before previous year. In profit and loss, there are only 2 columns, current year and previous year. So for current year, your COGS will be 159. How come? Opening stock increased by 10 million. Opening stock has a positive impact on COGS. So add 10 million. Closing stock increase has a negative impact on COGS because closing stock is deducted in COGS. So less it. You will get the COGS for 2 years. You will find the profit. Then when you are preparing SOCE extract, you are given the retained earnings on opening day of previous year, 423. Can I say before previous year also there was an impact of increase in GP by 10 million? Don't forget to give that impact. This impact 10 million did not come in profit and loss, but has to come in retained earnings directly. So first we will give that impact, and then once you get the retained profit, add previous year's profit and then add current year profits as well. You will get the retained earnings balance. Okay, so simple question, good question. Then there is one illustration number 18. What does it say? So basically it says that there was an error. We made some sale, but we forgot to remove it out from the inventory in previous year. So that, can I say your previous year closing stock is inflated? So your closing stock will get reduced. If your closing stock reduces, just imagine the trading account. Closing stock comes on the income side. If that income side is getting reduced, GP will also reduce. If previous year closing is inflated, can I say current year opening will also be inflated? So opening stock will also reduce. Opening stock comes on the expense side. If expense is reducing, GP will increase. This is the understanding part of it. Now, how does it impact? So basically the information was given for previous year and current year. Of course, see, do remember that watching the question in revision lecture is not a replacement of writing practice. You have to write in practice. I'm just discussing the key aspects of it. Here also the only important change is COGS. Have a look. In previous year, my COGS given is 53,500. Now imagine the impact of previous year. In COGS, closing stock is deducted, right? And I have to reduce my closing stock. That means you have to reduce a negative item, right? You have to reduce a negative item. So can I say minus and minus becomes plus? So that is why you plus it. One way of remembering it. Second way of remembering it is your GP should also reduce by 6,500. When will your GP reduce? When your expense increases. So COGS should increase. In the current year, vice versa. Find it out on your own. So you will get profit after tax. Also, number of shares were given for EPS. So we divided profit divided by number of shares. You will get the EPS as well. SOCE extract, very easy to prepare. Equity share capital was given. It does not change over the period. Retained earnings. Opening balance is given. Add previous year, add current year. You will get the balance. Acha, one more thing was given extra working in the solution. That is comparing the old figures and the restated figures. That means the old figures given in the balance sheet. For example, in the question, let's say for example, COGS given is 53,500. But as after rectifying the error, what is my COGS? It is 60,000. Can I say in restated, in new wala profit and loss, your COGS is increasing by 6,500, right? So this impact is shown in the solution as well. That increase in COGS 6,500. Likewise, you compare previous year old figures and previous and new figures. You have to show the impact of increase decrease. If you want to simplify it, ignore the positive negative sign. Just tell me the increase decrease of each and every item. Do practice it as well. Okay. Then do read illustration number 19. It is a very simple question. Okay. And then question number 2 as well. Just give it a read. Again, a very simple question. Just give it a read. Okay. So these are few questions which I would like to highlight for you. And this completes our revision of Ind AS 8. Accounting policies, changes in accounting estimates and errors. So I hope you like the revision. In case you like it, do like the video and also share it with your friends, and also do leave a comment so that it will motivate me and let me know your feedback on the same. That will help me. That will motivate me to upload more such videos. Okay. So I hope this was helpful. Thank you so much, everyone. Bye bye, everyone. Take care. See you all. Bye bye. So welcome my friends to another revision session, which is going to be in 100% English for my lovey-dovey South India students. Okay, so in this revision video again, we are going to revise all the concepts and questions in English. Concepts we will cover 100%. Questions whichever are important from exam point of view, which question even have one important adjustment, that I will try to cover in this revision video as well. So without wasting any time, let's start. But before starting, if you haven't subscribed to this channel and watching the revision video, oh my god, such a big sin you have made. So first subscribe and then watch the revision video. Also, the board notes which I use in my revision video, you can find it on my Telegram channel. So the link is in the description box. Go and join very quickly. Okay, chalo, let's start the revision in 3, 2, 1 and go. So the number is Ind AS 37. Name, provisions, contingent liabilities and contingent assets. Okay. So now before starting any of these pointers, we will first try to understand the definition of liability. So liability has 3 pointers. where there is a present obligation, past event, and where there will be an outflow of resources. This is known as a liability. Now, what is the meaning of obligation? Obligation simply means that there is no realistic alternative other than settling it. That means you have to pay it no matter what. Acha. But obligation can be of two types in case you remember. It can be legal obligation, it can be constructive obligation. So what is the meaning of legal obligation? Legal obligation is anything which arises out of a contract or a law, right? So if you have a contract where you purchased anything on credit, so it is a legal obligation, creditors. If you took a loan from bank, legal obligation. Okay. What is the meaning of constructive obligation? In case you remember my secretary example, I gave bonus to secretary every year without promising her. But if I gave it for a specific number of years, can I say in further years also she will expect the same? Constructive obligation. So it is nothing but a past practice, policy, or specific statement indicated to others that has created a valid expectation for the other party. Okay, just like you contaminated a river which you are not required to clean legally, but you have promised the villagers that you will clean the river. Constructive obligation. Okay, so this is obligation. Now then the next point is past event. What is the meaning of past event? For any liability to be booked, there should be past event. For example, in case of creditors, purchasing the goods on credit is the past event. In case of loan liability, taking the loan is a past event. Okay, which will result in outflow of resources. Outflow of resources means either you have to give cash or in kind or something you have to give. You have to make the payment no matter what. Acha, don't think from the point of view of Sri Vijay Malaya. Don't say that I will, sir, run away with the money. That we are not discussing. We are saying realistically you will have to make the payment. Anyways, now the next point is provision. What is a provision? It is nothing but a liability with uncertain timing or amount. Either the timing of payment is uncertain or the amount is uncertain. That is a provision. Okay. Now, when do you recognize a provision? So, recognition criteria of provision is linked with the definition of liability. Remember the 3 points: present obligation, past event, outflow of resources. Just add that it needs to be reliably estimated. When estimation is involved, it becomes a provision. Do remember that part. Okay. Yes. Then for this also, for any provision to be booked, there should be a past event. Apart from this, if any expense is avoidable, you should not book its provision. For example, if government says you need to inspect every 5th year, 10th year, 15th year, so this inspection will arise. This can be avoided. Why? By selling the aircraft. Okay, so you need not book any provision for the same. Also, if any new law is yet to come, that new law will create an obligation for you only when that is virtually certain. For example, Modi ji said that I will impose a cess of 1%, but this is not yet finalized. They are in talks to impose the same. So it is not yet virtually certain. So do not consider the same. Okay. Next is measurement of provision. So when you record any provision, you need to measure it. There are 5 pointers to it. First is best estimate. What is the meaning of best estimate? Best estimate means because we have to estimate the provision. How do we estimate it? So if there are large population of items, you will consider the probability. For example, in case of warranties, you sell so many products now, so you will have to consider the probability of each item, right? So let's say, for example, I sold 1000 units. I have given the probability of warranty claims and also the cost of claim. So I will use this probability and compute the value of provision. This is used when there are large population of items. But when there is a single item, let's say I contaminated the river, either I will give the cleaning process to contractor number 1 or contractor number 2. Here there are only 2 outcomes possible. So here item is single, outcome possible only 2. You will consider the most likely outcome. Anyways, present value. Second point in measurement is present value. Whether you will consider the provision at present value, the answer is yes only if time value is material. Example, in case of decommissioning, we used to consider present value only. Next, risk and uncertainties. What is the meaning of this? Let's say, for example, you are creating a provision of 2% on your sales. Let's say I'm iPhone company. Now with iPhone 15, there were some issues like heating issues, color fading, screen breakage or everything, due to which, can I say, customer claims will increase. So should I consider this risk and uncertainty and increase my amount of warranty provision? The answer is of course yes, you should. Okay. Next point is future events. What is the meaning of future events? Let's say, for example, I was watching a TV. I was watching a news channel where it was shown that Japan is thinking of making a technology which will reduce the decommissioning amount. But there is no evidence of this future event. They are in talks. So will you consider this future event and reduce the amount of provision? The answer is no. If no evidence is available, do not consider it. If the evidence was available, then you might consider it. Anyways, next is expected disposal of asset. What is the meaning of this? Let's say, for instance, you are closing some facilities. So when you close the facility, whatever is the closure cost, you will book a provision for the same. But when you close a facility, you will also sell your properties now, on which you can get some gain. this gain on sale of property is to be ignored. It will be booked only when it is realized. So the provision amount will be 10 lakhs gross. Okay. Next is provision required at the end of 10 lakhs. It is fine. Okay. Then use of provision. Provision you will create by passing the entry expense to provision. If this expense did not arise, you will reverse it. You cannot use this provision against any other expense. Do remember that. Next is changes in provision. You will review the provision at every year end. Why? Because it was an estimate. If there is any change in estimate, how can the estimate change? For example, let's say we were estimating previously. After few months, we came to know the exact amount. Can I say in that case the provision will become liability? So it is said that only. First review at every year end. Then if the obligation is crystallized, an exact amount is known, that will be classified as a liability. And also whenever provision was at a present value, you will do unwinding interest to provision. For future operating losses, what is the meaning of this? Let's say for example Kishan has a business. If he runs it for the next 3 years, he will have to incur a loss. This is future operating loss. You will not create any provision today for future operating loss because there is no past event. It has not yet arisen. Okay, good. Before moving further, before discussing contingent liability, contingent asset, I will discuss reimbursements now. See, if I want to show you the chart, how is the flow? First, I discussed the definition of liability and obligation. Then we discussed everything about provisions. Now, before discussing liability and contingent asset, I will discuss reimbursement, onerous and restructuring. Okay. So what is the meaning of reimbursement? Sometimes what happens is, let's say best example, your articleship. In articleship, whenever you travel to a client place, your principal says that we will reimburse your traveling expense, right? So the entry for reimbursement is expense to provision. Sorry, the entry for booking the expense is expense to provision. If this expense is reimbursed and that reimburse is virtually certain, you will book a reimbursement asset to reimbursement income. Few points to be remembered. Reimbursement asset will come in balance sheet. Provision will come in balance sheet. Net off is not allowed. But expense of provision will come in profit and loss. Reimbursement income will come in profit and loss. Net off is allowed. Second thing, book the reimbursement only when it is sure to be received. It is virtually certain to be received. If not virtually certain, just disclose it. Don't book it. Third, the amount of reimbursement cannot exceed the amount of provision. If any excess is promised, that excess will be booked only when it is actually received. Do remember that part. Okay. This was reimbursement. Next is onerous contract. In short, it is known as loss making contract, where the unavoidable costs are going to exceed your benefits. So if you enter into a contract and after entering you come to know that now this contract is going to be a loss, so you will book a provision for this loss. Okay. So let's say for example, we enter into a construction contract where I thought the expense was only 1 CR, but it actually turned out to be 1.3 CR. My revenue is only 1.2 CR. So loss is 10 lakhs. So I will make a provision of either the loss, or there can be a possibility where you can make the penalty and move out of the contract. So loss or penalty, whichever is lower, because if the loss is lower, I will make sure that I fulfill the same. Okay. There is an amendment also here, not very crucial, but just remember that when you are calculating the cost, when you are calculating the expense, also consider the expense of depreciation and impairment losses. If any PPE was used, let's say in construction we used bulldozers and everything, so the depreciation of bulldozer and impairment loss of disposal will also be considered here. Do remember. Acha, further. Next point is restructuring. What is the meaning of restructuring? It means that when you change the scope of a business or the manner in which business is conducted. For example, let's say from today I decide that instead of teaching I will do singing. I am changing the scope of my business. Or let's say instead of offline teaching I will shift to online teaching. I am changing the manner in which my existing business is conducted. This is known as restructuring. If you decide to restructure, should you book a provision? Yes, but only when an obligation arises. And when does the obligation arise? Only when you have prepared a detailed formal plan and you have created a valid expectation. And how is a valid expectation created? Either you have started to implement the plan or you have announced this plan to those affected by it. Okay. If obligation arises, you will have to create a provision. Now, which amount will come in provision? So I have taken a good example for you in case you remember. Let's say, for example, I was into offline teaching. Now I will close my offline teaching and shift to online teaching. So there are two expenses involved. One is related to the closure of this offline teaching, where I will lay off the employees, where if I was taking the offline class on rent, that rent is a non-cancelable contract. I will have to make the payment of rent and other relevant expense for closing the business. In restructuring provision, you will only consider these expenses which are related to the closure of the business. Okay. But let's say you are shifting to online teaching. So when you start online teaching, you will have to invest in technology, hire new employees, train the new employees, marketing expense. These expenses you will not consider in the amount of provision. Why? Because these relate to future conduct of business. So do remember, in the provision of restructuring, consider only those expense which relate to the existing closure of business. If it relates to the future conduct of business, it will not come in restructuring provision. The same is mentioned here as well. Clear, guys? Yes, sir. This is clear. Chalo. Now the two remaining points were, one was contingent liability. Do remember, contingent liability is never recorded, it is only disclosed. But there are three definitions for contingent liability. What are those three definitions? Let me discuss this very, very quickly. So this definition is linked with the recognition criteria of provision. Remember the recognition of provision: present obligation, past event, outflow, and reliable estimate. Once any one condition not fulfilled, it becomes a contingent liability. How come? If instead of present obligation, it was a possible obligation, it is a contingent liability. If there is a present obligation, past event, but outflow is not probable, contingent liability. If it is a present obligation, past event, outflow is probable, but amount cannot be estimated reliably, contingent liability. In case you remember, I made you remember that also. Okay. What is present and possible obligation? Present means more than 50% chance that we'll have to pay it. Possible means less than 50% chance that we'll have to pay it. Okay, do remember. Also given a summary of all the three definitions for you. Okay, so this was contingent liability. If there is any contingent liability, what will you do? You will disclose it. Okay, next. If the possibility of payment is very remote, no need to disclose. Third, if for any liability you are jointly liable, for example, Hema and Supraja took a joint loan. Out of this joint loan, 75 crores belong to Hema and 25 belongs to Supraja. What is the main motive of taking a joint loan? They become the guarantor for each other's share. So for example, for Hema, her share was 75 CR liability. The other party's share becomes a contingent liability for Hema because she becomes a guarantor for Supraja. Same applies for Supraja also, right? So now you can read any joint liability, own share, it will be liability. Other share, it becomes a contingent liability. Last point, the contingent liability also needs to be reviewed at each year end. Next point, contingent asset. It is nothing but a possible asset that arises out of past event whose occurrence will be confirmed in future only. What to do with the contingent asset? If the inflow of the asset is virtually certain. So it says if the inflow is virtually certain. For example, I did a case on Ajay. I won the case. Penalty amount I will receive is 50 crores. Court has said to Ajay that Ajay has to pay 50 crores to me. Only the payment is yet to be received by me. In this case, we will say inflow is virtually certain. When the inflow is virtually certain, it is no more a contingent asset. It has become an asset. And when it becomes an asset, recognize the same. If the inflow is probable but not virtually certain, that means chances are of 50 to 95%. You will disclose the contingent asset. But if the inflow is not probable, less than 50% chance of receiving the inflow, neither record nor disclose. Acha, do remember in the first case, we are not recording a contingent asset. Because the inflow was virtually certain, I am saying that my contingent asset has now become an asset. So I am recording the asset here. Do remember that part. Okay. This completes the conceptual part of the chapter. To be very honest, the questions in this chapter are very straightforward. If you know the concept, you will know the question. So there are not many questions to be revised here. But yes, maybe 2 or 3 questions are there which I feel I need to revise. I will take those up. Okay. Illustration number 15. Not a LDR but a normal question. It says that we have received a notice from the income tax. Okay. So, and it is said that company is not confident of winning the case. So that means company feels that there are more than 50% chance that it will lose the case, present obligation. So create a, what you can say, create a provision for the same. Okay, do remember that part. Then next question is illustration number 18, a very good question based on restructuring. So basically what we are doing is we are discontinuing a business. Okay, obligation, we announced the same on 15th Feb. So obligation has arisen. Now, when we discontinue a business, we are terminating some employees. This termination payments will form part of the provision 540. But also there is Ind AS 10 involved here, adjusting event. So basically 540 was the normal provision, but when that FS are approved, by that date we have a new information that actual payment was only 520. So we will treat like an adjusting event and consider 520 lakhs. Apart from this, we are also making some relocation payments. Relocating means transferring employees from existing a business to new business. This is relating to future conduct of business. Do not consider in provision amount. Also, there is a lease, operating lease in the old business, which we have to cancel and make a payment 430 lakhs considered in the provision. But the actual payment turned out to be 410. adjusting event, consider 410. So 520 plus 410 make a provision of 830. Simple. But of course give the relevant 930, but of course give the relevant theory as well. Anyways, then the next good question is, I guess, the question number 1 of MTP RTP. What is happening here? See, there is a company QA Limited. So it sold something to customer. So customer made a filed a case against QA because the product was faulty. QA discovered that the product was faulty not from his end, it was faulty from the supplier's end. So QA in turn did a case on supplier. So basically, if we talk about QA, on one hand he will have to make a penalty outflow to the customer K. On the other hand, he will receive a penalty inflow from the supplier. So the penalty outflow here is a provision, but the penalty inflow here, the inflow of penalty is not virtually certain. It was not promised by the supplier. To recover the penalty inflow, you are doing a case on the supplier here. So this inflow is not virtually certain. So you will book it like a contingent asset here. So the payment of penalty is a provision. The receipt of penalty, it is because not virtually certain, it is a contingent asset. Now, there are many things asked in this question. I will just give an overview of the same. So first, let's talk about the penalty payment which you have to pay. So provision of 5 CR is estimated on 1st October. It was revised to 5.1 year end. Then 5.25 on 15th May, and on 1st June it turned out to be 5.3. So again you will feel like Ind AS 10 is coming into picture, but the FS were approved on 26th April. So if you see closely, year end is this, FS approved on 26th April, and few events happened on 15th May and 1st June. These events are not adjusting, neither they are non-adjusting, because they are happening after the date of approval of FS. They are out of the scope, so do not consider these events. So basically your provision amount will be 5.2. Ignore 5.25, ignore 5.3, because this 5.25 and 5.3 is after the date of approval of FS. Okay, then for the penalty received, any which phase, it is a contingent asset for us, so nothing to be done. First point, they have asked whether company is required to make the provision. Of course the answer is yes. Second part, amount of provision, it will be 5.2. Third part, what to do with the penalty inflow. Contingent asset, just disclose it. It may be disclosed. Simple. Then the next good question is, I guess, question number 6, which relates to warranty. So basically they are saying that we provided a 6-month warranty to the customer. Typically our gross margin is given as 40%, but we make the provision of 1% on gross margin. As of now, we are making the provision on 1% of gross margin. But when the company checked based on past experience, it is expected that the warranty claim will be 1% of equipment sold. That means the company made a mistake of making the provision on the gross margin amount. The provision should be made on the sales amount. Okay, so we rectified the same. How do we rectify? So first, we were given the amount of provision as per the gross margin, but no other information is given. Okay, no other amount of sales is given. So we have to reverse calculate and find the total amount of sales first, because provision is to be created on sales. So what we will do? We know that provision of 30,000 is 1% of gross margin. So with that, you can find the gross margin, cross multiply. Okay, you got the gross margin. Gross margin was 40% on sales. So you can find the sales through this. Then, because you are giving only 6-month warranty, for the first 6-month sale, warranty has already lapsed till year end. No provision on this sales. For the next 6 months, warranty is outstanding, make the provision. It comes to 37,500. Out of this, you have already created 30,000 in the books. Create additional 7,500. Simple. Okay. There is also case 2. Case 2, it says that what if the warranty period had been 2 years? What if the warranty period had been 2 years? Then, so in that case, you will create the warranty provision on full year sales. Okay. Don't make the mistake of taking the sales into 2. We are not asked to compute 2 years warranty provision. We are only asked to compute what will be the provision for the current year sales. So because the warranty is of 2 years, full sales which you made in current year is eligible for warranty. So we will create the warranty on full sales. Simple. Then this was question number 6. Then there is illustration number 7. Nothing much in this, seems to be a big question, but a very simple question. I will just give an overview of this. So what happens here is, company has entered into a owner's contract. Now for owner's contract, we know now we have to consider the cost, the revenue amount, and the net loss is your amount of provision. So for the cost, they have given some information that admin, finance, R&D, because these are indirect overheads, we have not considered the same in cost, which the management is correct. Then for computation of unavoidable cost, they have only considered material cost, labor cost, overheads, which are direct cost. Here also management is correct. Then they give the amount of onerous provision amount. So they have asked whether the treatment of by management is correct or not, is in line with India studies or not. One of the rare questions where whatever they have said in the question, it is correct. So you have to just affirm the same. You have just to confirm the same, that whatever they have done is it is correct. Okay, so normally we are used to saying that the accountant has done some incorrect treatment, but here everything was correct. So do remember, a good question, you can read it. Okay, so on this note we have completed our special revision of India 37 as well. I hope this proves to be helpful. Also, if you have not taken the lectures yet, and if you feel that you might need it, or if you feel any of your friends might benefit from this lecture, so you can recommend them the batch which is there in English. It is available on bbvachos.com. On that note, thank you so much. Bye bye everyone, take care, see you all. Bye bye.